So, how does $20 billion just vanish into thin air? That's exactly what happened in one of the most violent crypto crashes we've seen in a long time. Today, we're going to go inside the chaos to figure out what really went down using a postmortem from an expert who watched it all happen in real time.
$20 billion. It's a number so big, it's kind of hard to wrap your head around, right? Well, it got wiped out in a storm of forced selling that shook the entire crypto world. This wasn't just a market dip. This was a full-on financial earthquake, triggered by a massive, violent deleveraging event.
The worst liquidation event in crypto history. Those are pretty heavy words. They come from Jonathan Mond, a portfolio manager at Bitwise who had a front-row seat to the whole thing. And he's going to be our guide for this explainer.
But what really lit the fuse on this financial time bomb? Well, the answer is a whole lot more complex than just prices went down. This is a story about the hidden plumbing of the market and, how I completely and totally broke.
Right. So while all the headlines were screaming about falling prices, our expert says the real story was happening underneath the surface, deep inside the market's complex and, as it turns out, pretty fragile plumbing. So here's the crucial point. When panic hits, the market's lifeblood, that's liquidity, it just dries up. The very systems that are designed to keep trading orderly started to crack under the pressure, because the traders and algorithms that are supposed to facilitate all the buying and selling, they just ran for cover. And the result of that? Get this, a $65 billion black hole of open interest was just erased from the market. This didn't just hurt a few traders, this reset months of market positioning. It was like hitting the slate clean button in the most brutal way imaginable. So how in the world does $65 billion just get vaporized that quickly? Well, it all comes down to a specific type of financial instrument that, under pressure, started a chain reaction of falling dominoes, each one bigger and faster than the last.
They're called perps. The easiest way to think of them is like high-stakes bets on a crypto's price, but with no expiration date. The catch, though, is that everyone's chips are basically in a shared pot. And when the market turns, the casino has to settle all those bets at once, which creates this mad scramble for the exits.
And this is exactly how those dominoes fell. First, a sharp price drop. Bitcoin fell 13% in just 1 hour. Then, liquidity just vanishes, so the normal process of clearing out bad positions stops working. That forces the exchanges to hit the emergency auto-deleveraging button, which is just forced selling. And that leads to this death spiral of volatility where some tokens literally traded for almost nothing.
But here's where things get really interesting. Not all parts of the market crumbled in the same way. In fact, this whole crisis revealed a fascinating tale of two totally different systems. You have the old guard of centralized exchanges squaring off against the new world of DeFi.
And the contrast was just stark. The centralized exchanges, with their thinning order books, became this chaotic free-for-all. But DeFi protocols, which had stricter collateral rules and hard-coded price logic, actually acted like a firewall. They contained the damage and proved to be way more resilient.
I mean, just look at this. This shows you how completely broken the market got. At one point, you could buy the exact same asset for a $300 discount just by being on a different exchange. That's a complete breakdown of price discovery. That's just not supposed to happen.
Okay, so what are the key lessons we can actually pull from the wreckage of this massive financial fire drill?
Well, according to our expert, the biggest risks in a crash like this aren't even about predicting which way the market is going to go. It's all about the plumbing. Will your exchange stay online? Is the price you're seeing even real? Can you even move your money? These are the questions that separate the survivors from the casualties.
To put it bluntly, when the market's plumbing fails, it doesn't matter how great your trading strategy is. If you can't actually execute your trades, you're pretty much dead in the water.
So what's the bottom line here? First, the real systemic risk lives in the market's plumbing. Second, not all systems are created equal, and you have to understand their different breaking points. Third, every crisis like this creates a huge opportunity for anyone who has cash ready to go. And finally, after a storm this violent, the market was actually left on a much healthier foundation.
This crash was a brutal, real-world stress test, and the system survived, but just barely. But as crypto finance gets faster, bigger, and way more complex, the next storm is pretty much inevitable. So the question is, will the plumbing hold up next time? Or are we just building a system that's destined to break all over again?